Hello all, this is Saias, CCO of RBI Private Lending. Welcome everyone to a new session where we're going to be talking about one of our main products here at RBI, which is the construction loan program that we have here that has been amazing over the last few years here at RBI. Before we start talking about the construction loan programs that those of you are here for, let me give you a brief introduction of why RBI, who's RBI for those of you who don't know us. So RBI, first of all, is a private lender that specializes in any short-term products, whether it's bridge, fix and flip, construction loan products. We also have a DSCR program. RBI has a lot of experience, have been over 10 years of experience in the industry. We're currently second lender in terms of transactions in the private lending space, and we're a direct lender, which means that we have our own funds to close. In addition to that, RBI is also vertically integrated, meaning that we have in-house processes for asset management, underwriting, processing, closing, and so on. All this allows RBI to be fast, flexible, reliable, and transparent, which are critical for this industry, as you mostly know, as investors might need to have a lender that is very efficient and quick for their transactions. This is a little bit of an overview of where is RBI active. Pretty much as you can see in the map, RBI is almost nationwide with the exception of a few states, but we're more regionally focused in anything that is within the Sun Belt: Florida, Texas, Carolinas, Oklahoma, and so on. But as you can see, RBI has a strong presence in most of the states. Now, the main event, as most of you are here, we're going to be talking about our construction loans that are somewhat different than most of the other lenders out there. So it's very important for our investors to understand the few things that might be a little bit different than other lenders. So our construction loan programs are typically labeled that way and could be many things. Could be a ground-up construction, or could be any construction or any heavy rehab that entails structural changes. Whenever an investor is adding square footage to the property and therefore the structure might change, we can also label that as a construction loan. This program is accessible to anyone. Could mean that you are a foreign national, could mean that you are a new investor. Of course, if those are the cases, we might adjust and mitigate for those cases with the leverages that we're about to do so. But the important thing is that we are capable of giving a proposal to pretty much everybody. This loan product typically takes between 10 to 15 days to close, assuming the borrower provides us with the documentation on time. As to the leverage that we're willing to do in this transaction and this loan type are up to 82.5% of the loan to cost, or 70% of the after repair value, which we're going to be talking about in a second. For those of you who don't know the difference in terminology, we're going to be seeing that what does LTC mean and ARV as well. In terms of the interest rate, our rates start at 9.99. Our interest-only payments and is non-Dutch. What non-Dutch means is that the borrower only will be paying for the principal owed at that point in time. As most of you know, the construction loans, we are giving draws as the construction goes on, and as the developer or the investor continues to, throughout the process of the construction, the principal increases. Therefore, the monthly payment will follow. Also, this product does not have any sort of prepayment penalties, which means that the borrower can cancel the loan at any time and will only be paying interest up until that point. There's no additional fee. And typically, we are doing 1 to 4 units for this type of loan program. So what are the requirements for this type of products? Typically, is very straightforward. We need identification, credit application, latest bank statement showing the liquidity that we need, insurances, both builder's risk and general liability, investor's track record, approved plans and permits, a purchase contract if needed, if that's the case of a purchase, a construction budget, a signed term sheet, and any information regarding the GC that could mean the contract between the borrower and the GC license, and the history of the GC over the last few years. Now, going back to the terminology, it's critical to understand how we calculate the loan amount. And in order to do so, we need to understand the terms that we use. So typically for anything that is fix and flip and construction, we change our terminology from loan to value to loan to cost and after repair value. So first of all, loan to cost just means the loan amount relative to the cost of the project. Now, the cost of the project is important that we're going to separate from this equation the soft cost. So we're only going to account for this purpose, for the purposes of this for this calculation, we're only going to be accounting for land plus the hard cost, meaning the construction costs. So no soft cost will be involved in this equation. With regards to the after repair value, this means the value that the property will have once it's completed. This will be determined by an appraiser that will find comparables based on recent sales in the neighborhood or nearby, and we'll see what are according to the specifications of the project, we will find comparables, and that will give us the after repair value of that project. With regards to the contingency, it is important to mention that when we're talking about a construction loan, we're talking about a large project that might have issues that happen throughout the process that we need to mitigate those risks. In order to mitigate those risks, what we recommend our borrowers is to include a 10% contingency within their budget, so that way we can use that line whenever there have any hiccups. Maybe they might need, there's a change in the price of materials along the way. So this line will allow the investors to mitigate those risks. Also, other terms that are important to mention are land, which is typically, as most of you know, the value of the land, and the purchase price of the land. Now, if the land was purchased over 12 months ago, we can use the current value of that land rather than the purchase price. And then the other two main components that are very important to understand that we just briefly mentioned are the soft cost and the hard cost. The first one, which are the soft costs, tend to be all expenses that are incurred before the construction phase. These could include plans, permits, architecture, engineering, all these that are whether happen to be before the construction phase and could be also be known as indirect costs. These are costs that are intangible, that they don't add any direct value to the property and are very subjective. The other one is the hard costs. The hard costs are costs that happen throughout the phase of the construction. These are material, labor, GC fees, and so on. Those are very important, and these are directly affecting the value of the property. These are the ones that we include for the calculation of the LTC with the land value. So this slide mentions once again the importance of the separation of the three components that a construction project might have, which are the land, the hard cost, and the soft cost. As you can see here, the LTC is only using the land plus the hard cost. So no costs, no soft costs are involved in this equation. Now, how do we draw on our construction loans? And before I enter into this, I want to mention that if any of you have any specific situation or any scenario that you want us to look at, You can also do so by reaching out to any of our team members or filling out the application on our website, or you can also leave in the chat so one of our team members can help you with that. But moving along, the draw process is very important to understand when are we available to provide funds to the investor. So the first part is to understand that we calculate based on the borrower's experience and their profile. We're going to estimate the loan amount, which is going to be the lesser of a certain percentage of the loan to cost and a certain percentage of the after repair value. The lesser of the two will determine the loan amount. So that's the first step. Once we understand the loan amount of that project, we're going to be able to identify what's the equity required that this investor might need throughout the project. Now, once we have the loan amount and we have the equity requirement for this investor, we are going to be able to understand where are we in the phase of the construction. Have the investor met their equity requirement? Have they not met their equity requirement? If they haven't met their equity requirement, they have to finish their equity requirement first, and then that's the moment that they're capable of getting our funds. So it's important to understand that first comes the borrower's equity, then comes the lender funds, in this case RBI. So here's, in this slide, we can see a little bit more of that for illustration purposes. We can see a timeline here. The timeline mentions in point 0, nothing has happened, it's just raw land, not even purchased at the moment. Point 100%, the property is completely done, and you have your house or whatever you're building. In this example, we're making the assumption that RBI is providing 80% of financing of the loan to cost. Of the total cost of the project, 80% is going to be financed by RBI. So if that happens, our 80% will be the last 80%, which means that the first 20% is going to be provided by the borrower. Now, it is important to understand that that 20% of equity can only be including, or you can only account for, by using land and hard cost. So no deposits, no soft costs, no closing costs. Those are all excluded from the equation. Only the land, and sometimes the land will be more than enough to cover for that 20% if that's the approval that the borrower might get. But it's important to understand that every project is different, and we need to see that, and we're going to see that in a few examples in a second. Before we go to to those examples, I want to make sure that we understand how the disbursement policy is here at RBI. So basically, the draws are being based on job completed. So no draws will be made for materials nor job to be completed. Typically, the draws take between 5 to 7 business days from the moment that the investor asks for the draw until the moment that the borrower gets their funds. How is the process? It's very simple and straightforward. So first, we have the investor who will fill out a form, who will be asking us for a draw of a specific number of lines from their budget. They're going to be specifying what have they completed thus far, and the amount that they're requiring. We provide that form to the inspector, and the inspector will go to the site and review that actually all these items have been completed. Once the inspector reviews it, they will provide a report to us back at RBI. We will take a look at it, and we'll probably, if everything goes well, we're going to be able to provide funds. If there are any cutbacks, we're going to provide those. We're going to provide the report to the investor so they can review it, and if there's any objection or any dispute, we can talk about that. But if everything goes well, we proceed to funding. One of the important things at RBI is that we are capable of getting their draw requests throughout our website. If you see here, this is an example from our website. You can see at rbiprivatelending.com. On the right side, you can see that there's a request draw blue button that you can click on there, and you can make your requests throughout any point in time. So now we can see here a few examples as to how the construction loan works and that timeline that we were just talking about. So let's see the first example. So let's assume first that we have an investor who has above 680 FICO score and 2+ properties of experience. So this investor will be approved with an 82.5% loan to cost or a 70% after repair value. Now, the land value for this property is $300,000. Let's say that the hard costs for this project is $300,000 plus a 10% contingency, which is $30,000. Assuming that we're taking that that land of 300 and we're putting 330,000, let's assume that the after repair value is $800,000. Let's say that we have the loan amount is going to be the lesser of the two. It's going to be the lesser of 680, which is the sum of the land plus the hard cost, or 70% of the 800,000. The lesser of those two numbers is 519,750, which is in this case 82.5 of the 630. Now that's our first step. Step one, which is calculate the loan amount. Once we understand the loan amount, we can understand the investor's equity required for this project, which is in this case the difference between the total cost of the project, which is 630, minus the loan amount that we're getting. So the difference between 630 and the 519,750 is going to be 110,250. That's our step two, which is calculating the equity required by the borrower for the project. Remember, we need to have the investor put this into the project before being capable of getting any draw or any funds from RBI. Now, the third step is to understand where are we in that phase of the construction. Have the borrower bought the property? Has the construction started? It all depends on where are we in that timeline. In this example, just to make it easier for you, we're just making sure that the investor is just buying the property. Just bought the land for $300,000, debt-free, paid cash for the lot, has plans, permits ready to go, hasn't done any work on the property yet, so only the land value. In this example, because the land is worth more than the equity required, the investor has an overinvestment of $189,750, which is in their favor. So they will get that at the moment of closing, minus closing costs, of course, but they will be able to get those funds to start the construction. This is not a draw to start the construction, but it's a draw based on the fact that the investor has more invested into the project than the required investment, which was $110,000. So therefore, the investor gets, in this case, $189,750, and then there's a remaining holdback of the $330, which is basically the 100% of the hard cost, pretty much, including contingency. Now, moving along to a similar example with the same exact borrower, same characteristics. Let's assume for the sake of this example that we're building the same house, with the exception that we're going to be building it at a different neighborhood. Let's say that we're going to find a more humble neighborhood, that the lots are worth they're worth less than the $300,000, and let's assume that it's a $50,000 lot, assuming that we're building the same exact house, and assuming that the after repair value is going to be cheaper because we're building it at a different neighborhood, maybe a suburban market, if you will. So in this example, the purchase price of the lot is $50,000. The hard cost is still $300 plus the $30,000, and then the after repair value is $550. If we do the same borrower, the numbers for the same borrower, and let's do 82.5 LTC of 380 or 70% of the 550, we will get a loan amount of $313,500. Okay, that's step one again. Step one, calculating the loan amount. Step two will be what's their equity requirement. The equity requirement again here is going to be the difference between total cost and our loan amount. So 380 minus the 313,500 will give us an equity requirement of 66,500, right? So now, for the purposes of maintaining the same synergy with the other example, let's assume that we're in the same point in time, which is only buying the lot at $50,000. So in this case, if the equity required by the investor is 66,500, and we have only invested the land, which in this case is $50,000, the investor is short. So the investor hasn't met their equity requirement. In fact, they're short by 16,500. So in this example, our initial draw at closing will be zero. The investor can close this loan, no problem. They can close the loan, and they do not need to provide these funds to us. Rather than that, they need to provide that into the project. They need to apply that to the property, and that means that they have to start the construction phase with their own funds. So in this example, the initial draw, if they want to proceed and close this, the initial draw will be zero, and the holdback will be $313,500. So pretty much we can see that even though we're having the same borrower building the same house, with the exception that the land value is very different, we can see that the numbers might change drastically. In the first example, as we can see, the investor has an overinvestment of $189,750, which are capable for the borrower to get at closing, whereas in the other example, the investor is short by 16,500. So this explains us that the land is critical to understand these construction loans. It's critical to understand that the more value the land has from the entire project, the more the investor has provided into the project, the more they're capable of getting funds at the closing.